Imagine you build this massive, impenetrable dam across a raging river. You spend years reinforcing it, piling the concrete high, right?
Yeah, making sure it's completely locked down.
Exactly. Assuming that by blocking the flow, you'll eventually, dry out the valley below. But water is relentless. It doesn't just disappear.
No, it just finds somewhere else to go.
Right. It pools, it rises, and eventually it carves an entirely new path through the mountains, flooding valleys you didn't even know existed.
Yeah.
And the economic, geopolitical, and technological data we're looking at from 2025 and early 2026.
It tells a remarkably similar story.
It really does. It's a story about global trade.
Uh-huh.
And I want to be super clear right up front for you listening. As we dig into these highly sensitive geopolitical moves between the U.S., China, and various global allies, our only loyalty today is to the data.
Right, absolutely.
We're not here to endorse policies or ideologies or governments.
Right.
We're strictly acting as impartial guides to look at the math of how the world is fundamentally rewiring itself.
And it is a massive rewiring. I mean, it's a repositioning born entirely out of pressure. We are looking at a system that was hit with unprecedented friction, and rather than collapsing, it found a new equilibrium.
Yeah.
In fact, analysts are calling it the most consequential strategic repositioning since China joined the World Trade Organization back in 2001. And we're going to cover the four main pillars of this today: trade, infrastructure, monetary architecture, and technology.
Okay, let's unpack this, starting with the catalyst, the river hitting the dam. To understand the direction of travel right now, we really have to look at the immediate pressure applied back in 2025.
Right, the tariffs.
Yeah. The U.S. imposed its most aggressive tariff regime in modern history, and on paper, it actually achieved its stated goal. I mean, China's exports to the U.S. plummeted by 28% in a single year.
Which is massive.
It's huge. By conventional metrics, losing nearly a third of your primary export market, that should trigger a massive domestic recession.
Well, under normal circumstances, yeah, absolutely. I mean, a 28% drop is a severe structural shock. But their response was completely counterintuitive.
Right.
Instead of a manufacturing retreat, China actually posted a trade surplus of $1.189 trillion in 2025.
Wait, $1 trillion?
Over $1 trillion, $1.189 trillion. It is literally the largest trade surplus ever recorded by any country in economic history. It was a nearly 20% jump from 2024.
That is just wild.
And it gets crazier. By the first quarter of 2026, their GDP growth had reaccelerated to 5.0%, and their April 2026 exports hit a record $359.44 billion.
Wow. Okay, so a $1.189 trillion surplus basically defies the gravity of those tariffs, which means the dam held against the U.S. market, but the manufacturing capacity didn't shut down. The goods just flooded new valleys.
Exactly.
But looking at the sheer scale of those numbers, I mean, there's a mechanical problem here. You can't just take over $1 trillion in surplus goods like solar panels, EV components, heavy machinery, and just instantly dump them into emerging markets, right?
Right. You can't do it instantly, but you can do it systematically. And the data shows a highly coordinated redirection of their manufacturing surplus. They pivoted away from North America and went straight into the global south.
So we're talking Latin America, the Middle East.
Yeah, Latin America, Middle East, Africa, and Southeast Asia. Plus, they aggressively targeted the European Union. They ran a $113 billion surplus with the EU in just the first 4 months of 2026 alone.
Wow. Just 4 months.
Yeah. And there's actually a really strong historical precedent for this. Analysts point to the 1985 Plaza Accord.
Oh, right. When Western powers effectively forced Japan to appreciate the yen because Japanese exports were just dominating the global market.
Exactly. The U.S. and its allies applied immense pressure on Japan's export-driven model. But Japan's response wasn't to just deindustrialize, it was to offshore and integrate.
They built factories everywhere.
Right. They built supply chains across Southeast Asia, effectively creating Asia's first modern manufacturing network. What the 2025 data shows is a structurally similar maneuver, but executed on a truly global scale.
So the external pressure of the tariffs basically acted as the catalyst for them to build a much deeper, more insulated regional economic architecture.
Exactly.
But that brings us to the logistical reality of pivoting to the global south. I mean, if you want emerging markets to suddenly absorb a $1 trillion trade surplus, they need the physical capacity to actually receive the cargo.
Right, the physical infrastructure.
Yeah, you need deep water ports for the freighters, you need inland rail networks, and you need like industrial energy grids just to power the warehouses. You can't just drop 1 million solar panels on a beach.
You can't. You have to physically build the demand capacity yourself, which is why the infrastructure data from 2025 is so incredibly critical. For years, the Western narrative kind of dismissed the Belt and Road Initiative as a series of disjointed vanity projects.
Right, like a rusted bridge here, an underutilized port there.
Yes, exactly. But the new numbers completely shatter that narrative. In 2025, China signed a record $213.5 billion in new Belt and Road deals.
Wow.
That's a 75% acceleration from the previous year.
And looking at the breakdown of that $213 billion, it's heavily concentrated. It's not just, random highways to nowhere.
No, not at all.
It's $93.9 billion going directly into the energy sector, and another $32.6 billion into metals and mining. The anchor investments are hitting countries like Nigeria, Kazakhstan, the UAE, and Indonesia.
Yeah.
And their cumulative engagement across 150 countries is now hovering around $1.399 trillion.
And that concentration in energy and metals, that's what analysts are referring to as resource locking.
Resource locking.
Yeah. I mean, this isn't charity, right? It's a closed-loop system. They are securing the long-term commodities, the lithium, the copper, the oil that are required to fuel their domestic manufacturing base back home.
Right.
And in return, they are building the infrastructure that makes those nations dependent on Chinese engineering and Chinese logistics. The historical parallel that gets cited a lot here is the U.S. Marshall Plan after World War II, where the U.S. used infrastructure investment to embed its economic standards across Western Europe.
I mean, the Marshall Plan is a solid comparison, but structurally, it feels entirely different to me.
How so?
Well, the Marshall Plan was essentially the U.S. offering to remodel a house using the existing electrical wiring that everyone already agreed on, namely the Western financial system.
Okay, yeah.
What we're seeing with this Belt and Road expansion is more like laying entirely new wiring in neighborhoods that the original electricians completely ignored.
What's fascinating here is that the physical wiring is really only half the equation. You've isolated the exact vulnerability of the old system.
Right.
Because think about it. If you build a massive deepwater port in Nigeria, or a state-of-the-art logistics hub in Indonesia, but the local governments still have to clear the payments for those projects in U.S. dollars using the SWIFT network.
Then the United States still retains ultimate leverage.
Exactly. You can't truly control the physical trade routes if you don't control the currency flowing through them.
Which means all of this physical infrastructure is essentially useless as a bypass mechanism unless there's a parallel financial rail to actually process the money.
Precisely. And that brings us to the third pillar, the monetary architecture. This is why February 2026 is such a vital data point.
What happened in February?
That month, China executed the first major structural overhaul of its cross-border interbank payment system known as CIPS in 8 years.
Okay.
They upgraded it from a limited platform that essentially only settled transactions in Chinese yuan to a multi-currency, real-time gross settlement network.
Okay, let's break down the mechanics of that because real-time gross settlement is a heavy piece of financial jargon for anyone not working in banking.
It is, yeah.
So under the traditional SWIFT system, international transactions usually bounce through these correspondent banks, and they often settle in batches at the end of the day, which creates a paper trail visible to Western regulators.
Yeah.
But a real-time gross settlement, or RTGS, means the money moves instantly on a one-to-one basis, bypassing those traditional Western clearinghouses entirely.
That's the mechanical difference, exactly. To use an analogy, the old CIPS system was basically like a store-specific gift card.
Okay.
It was useful, but you could only use it in one ecosystem for one currency. The February 2026 upgrade turned it into a globally accepted network, like a Visa card, capable of handling complex multi-currency trade flows instantly.
Wow.
And the adoption curve is incredibly steep. CIPS is now connecting 1,729 institutions across 189 countries.
That's huge.
In March 2026 alone, they processed 1.22 trillion yuan in a single day.
That's roughly $178 billion processed in 24 hours, completely outside the view or control of the traditional U.S.-led financial system.
Yeah.
So if these emerging markets are adopting this to clear their Belt and Road infrastructure debt and to buy subsidized Chinese exports, doesn't that fundamentally rewrite the rules of global financial gravity?
It creates a powerful parallel pull. If we look at the Bank for International Settlements data, the yuan share of global foreign exchange trading has already jumped to 8.5%.
Right.
Even though its share of global SWIFT payments is hovering a bit lower, around 3%, that's really because so much volume is migrating over to CIPS. It is
Yeah.
no longer just a theoretical alternative. It is a functioning, parallel global payment infrastructure.
It's real.
Very real. It actually mirrors the ambition of the Soviet Comocta system in the 1950s, which tried to build a parallel trade bloc to bypass Western financial isolation. But China's version is vastly more sophisticated. It's fully digitized, deeply integrated into emerging markets, and backed by a manufacturing base that produces a third of the world's goods.
Right. So we have the trade rerouted to the global south, the physical deep-water ports and smart grids built to receive it, and a new real-time financial network to clear the payments.
Yep, the first three pillars.
But to manage an interlocking system of automated logistics, smart energy grids, and instant global finance, you need an immense amount of computing power. You need AI.
Absolutely.
Which brings us to the foundational layer, our fourth pillar, semiconductors.
Silicon is the substrate of this entire repositioning. The U.S. understood this, which is why the export controls implemented over the last few years were specifically designed to freeze China's artificial intelligence capabilities.
Right. The goal was to cut them off from those extreme ultraviolet lithography machines, the ones needed to manufacture the world's most advanced microchips.
Exactly. But the pressure seems to have triggered the same kind of counterreaction we saw with the tariffs. According to the data, China's national research and development spending surged by 48% over a 5-year period.
A 48% jump is staggering.
It is. And then there's the April 2026 report from the American Enterprise Institute, which identified something they call the lithography loophole.
The lithography loophole.
Yeah. It's a brilliant piece of mechanical improvisation. The U.S. banned the export of the newest, most cutting-edge chip-making machines. However, Chinese semiconductor manufacturers like SMIC, alongside Huawei, already possessed a fleet of slightly older, legally purchased, deep ultraviolet machines from the Dutch company ASML.
Right, the previous generation of machines.
Exactly. The AEI report details how these companies are utilizing a manufacturing technique called multi-patterning to squeeze more out of them.
Let's explain how multi-patterning actually works, because it's fascinating. Think of it like trying to draw an incredibly detailed blueprint with a marker that's slightly too thick. You can't draw the fine lines in a single pass.
Right.
But if you make a stencil, draw one set of lines, shift the stencil a fraction of a nanometer, and draw again, you can eventually create the intricate pathways you need. So they are taking silicon wafers and running them through these older machines multiple times to legally etch near-frontier 7-nanometer chips.
It is slower, yes, and the yield rates, percentage of functional chips per wafer, those are much lower, making it significantly more expensive, but it strategically works.
Yeah.
SMIC is currently doubling its 7-nanometer production capacity, and they're actively piloting 5-nanometer lines. Huawei is even projecting $12 billion in AI chip revenue for 2026 alone. The technological gap, which was supposed to be frozen, is actively narrowing.
Okay, here's where it gets really interesting, though. Because if we look at the customs data from the fourth quarter of 2025...
Oh, the import surge.
Yeah, China imported $135 billion worth of foreign semiconductors in a single 3-month window.
Yeah.
So wait, if they have mastered multi-patterning and are successfully closing the gap with their own domestic 7-nanometer chips, why are they panic buying $135 billion in foreign silicon? I mean, that doesn't sound like a self-reliant system. It sounds like a system flashing red.
The customs data absolutely validates your skepticism there. The narrative of smooth self-reliance actually hides an immense amount of internal friction. Multi-patterning, as we discussed, is highly inefficient. And the demand for AI computing power inside China right now is astronomical. In February 2026, Zhao Haijun, the CEO of SMIC, issued a remarkably candid public warning. He stated that domestic tech companies are attempting to build a decade's worth of data center capacity in the span of just 1 or 2 years.
Wow.
All to run these new smart grids and logistical networks.
So the domestic chip foundries simply cannot manufacture the silicon fast enough to meet the demand of their own infrastructure build-out.
Exactly. The sheer volume of AI compute required to run this parallel global system is vastly outpacing their domestic yield rates. The $135 billion import surge was essentially a frantic stockpiling effort. They are sprinting an absolute marathon, but they are doing it on an unfinished track.
Which brings us to the ultimate question of where this all leads. We have the 4 components: the trillion-dollar trade redirection, the massive Belt and Road physical expansion, the CIPS financial bypass, and this frantic, improvised technological race.
Right.
And looking across all the source material we have, there's a deep division among analysts about the endgame here.
Oh, the divide is stark. On one end of the spectrum, you have bullish economic analysts like Michael Pettis. He argues that China's massive trade surplus is structural, not cyclical,
Okay.
because domestic consumption inside China remains artificially suppressed by their economic model. They have no choice but to export their excess capacity to maintain growth. Pettis argues this machine is mathematically unstoppable.
So even with pushback.
Right. If you block it in the West, the capital and goods will simply carve a new path through the global South, exactly as the 2025 data shows.
But then you have the skeptical analysts, like those at the U.S.-China Economic and Security Review Commission or the Asia Society Policy Institute, and they're pointing to massive structural risks.
Yeah, they are.
They highlight that China's domestic retail sales grew by a marginal 1.7% in March 2026. The internal economic engine is just sputtering.
Synthesizing these conflicting viewpoints, the reports outline three highly distinct future scenarios. The first is managed dual-track globalization.
Okay, what does that look like?
In this scenario, the friction stabilizes and the global economy formally splits into two overlapping yet distinct systems. The West remains strictly dollar-dominant and reliant on SWIFT, while the global South becomes increasingly integrated into the yuan, CIPS, and Chinese logistical rails.
Basically, it's the two rivers flowing side by side. What's the second scenario?
The second is the Iran war spillover. This is a stress test scenario. The ongoing conflict in the Middle East severely disrupts global shipping and energy markets. Because China's new infrastructure heavily relies on securing energy from the Middle East, a regional war would test the absolute limits of the newly upgraded CIPS system and their strategic reserves.
Wow.
It's an external shock that could derail the entire repositioning.
And the third scenario, because this one seems the most structurally dangerous from what I read.
The third is the deflationary shock. This is the worst-case scenario mapped out by the skeptics. It posits that China's domestic demand completely collapses, likely driven by the ongoing slow-motion crisis in their property sector.
Right.
To prevent massive unemployment and social unrest at home, the state heavily subsidizes the manufacturing sector to run at absolute maximum capacity.
But if no one inside China is buying, they have to export everything.
Exactly.
And if the U.S. and EU have tariff walls up, and they flood the global South.
But let's look at the mechanics of that. I mean, if you are a developing economy in Brazil or Indonesia, and suddenly your market is flooded with heavily subsidized EVs, solar panels, and consumer goods priced way below the actual cost of production, doesn't that instantly bankrupt your local domestic industries? That is the exact mechanism of a deflationary shock. The very economies in the global South that China has spent $1 trillion courting with Belt and Road infrastructure would find their native manufacturing bases totally decimated by an unregulated flood of cheap Chinese exports.
That's devastating.
It transforms a mutually beneficial trade relationship into a highly extractive one. The entire parallel ecosystem would risk collapsing under the weight of China's internal imbalances.
So what does this all mean? For you listening, it's easy to look at a $1 trillion trade surplus in Asia or a new payment rail as just, abstract geopolitical math. But the rewiring of global trade eventually hits the local economy.
If we connect this to the bigger picture, the stakes are deeply personal. This isn't merely a shift in trade statistics. It is a fundamental transfer of financial gravity.
Right.
If the CIPS network continues its expansion and the yuan successfully captures, say, 10 to 15% of global trade settlements over the next decade, the systemic demand for the US dollar organically decreases.
Because central banks in the global South no longer need to stockpile as many dollars in reserve just to clear their daily energy and trade payments.
Correct. And when global demand for the US dollar drops, foreign central banks purchase fewer US Treasury bonds. That makes it harder and significantly more expensive for the United States to finance its national debt.
Yeah.
For you, the listener, the mechanics of that translate directly into your daily life. Higher yields on government debt mean higher borrowing costs across the board.
So higher mortgage rates, more expensive car loans, tighter credit.
Exactly. It could force severe fiscal austerity or trigger sustained inflation in Western economies. The mechanism is slow. I mean, it's a multi-year shift, not an overnight crash. But the direction of travel is firmly established by the 2025 data.
It's like watching a tectonic plate shift in real time. You don't necessarily feel the ground moving while you're drinking your morning coffee, but it is fundamentally changing the shape of the map beneath you.
That's a great way to put it.
And that leaves us with one final, provocative thought to mull over. We spent this time examining how a single, integrated global economy is actively fracturing into two distinct, self-sustaining systems. A Western one and a Chinese-led one, complete with their own physical ports, their own parallel financial payment networks, and their own completely isolated semiconductor supply chains.
Right.
But if the world fully solidifies into two incompatible financial and technological ecosystems, how will humanity actually coordinate a response to the next truly borderless global crisis? I mean, if another massive pandemic hits or a catastrophic climate disaster strikes, how do we mobilize a unified response when the two halves of the globe literally no longer share the same digital or financial language?
This raises an incredibly important question about the limits of parallel systems.
Mhm.
If you cannot clear a financial payment to a crisis zone, or if you cannot seamlessly share an unencrypted epidemiological data model, or even if you can't trace an emergency supply chain across the systemic divide,
Yeah.
basic global cooperation goes from being politically difficult to being structurally impossible.
You might maintain perfect control over your side of the river, but you lose the ability to navigate the ocean. Thank you for joining us on this deep dive. We hope this exploration of the data provides a clearer lens for the headlines you'll be seeing over the coming months. Keep questioning the narratives around you, and we will see you next time.